how annuities actually work, the math, and the strategy. Welcome back. In our first video, we covered the basics of annuities, the what and the why. Today, it's time to look at the how. Specifically, how do you take a pot of money, turn it into a paycheck for the rest of your life, and protect that money from life's curveballs? The easiest way to think about an annuity is like a reverse life insurance policy. Life insurance pays out when you pass away to protect your family. An annuity pays out while you're alive to protect you from outliving your money. You hand an insurance company a lump sum, and they hand you back regular checks. But not all annuities are created equal. Today, we're breaking down the main types, exactly how the math works behind the scenes, how to protect your family's inheritance, and the one massive fee trap you need to avoid. Let's get into it. The timeline, when do you get paid? The first fork in the road is deciding when you actually need the money. This gives us two main options. 1. Immediate annuities. Just like it sounds, you hand over a lump sum, and your monthly checks start almost immediately, usually within a month or so. How do they figure out your paycheck? The insurance company calculates it based on your exact age, current interest rates, and your life expectancy. Simply put, the older you are when you buy it, the bigger your monthly check will be, because the insurance company expects to pay you for fewer years. 2. Deferred annuities. With this option, your money sits in the account and grows for a few years before you start taking it out. The massive advantage here is called triple compounding. Because the account is tax deferred, you earn interest on your original money, interest on your interest, and interest on the money you normally would have paid to the IRS each year. It's a snowball effect for your wealth, how money grows in annuities. If you go with the deferred annuity, you have to decide how you want that money to grow while it's sitting there. Depending on how much risk you like to take, you've got 3 paths. 1. Fixed annuities. Think of these exactly like a bank CD, but issued by an insurance company. The good is absolute safety. Stock market crashes cannot touch it. The bad is fixed rates might not keep up with crazy inflation. Also, when you eventually take the money out, your gains are taxed as regular income, which is usually higher than the tax rates you'd pay on normal stock market gains. 2. Variable annuities. This is basically a tax-deferred wrapper around mutual funds. The good is high growth potential. If the stock market goes on a massive run, your account captures those gains. The bad is you take on 100% of the market risk. Plus, these are notorious for stacked fees. You might pay 1.25% for insurance fees, 0.75% for the fund fees, and another 1.20% if you add extra features. Suddenly, you're paying around 3.5% in fees. The stock market has to grow by 3.5% just for your account to break even. 3. Fixed indexed annuities. This is the middle ground. Your principal is protected from market losses, but your growth is tied to a market index like the S&P 500. The rules of the game is the insurance company limits your growth using caps or participation rates. A cap means if the market goes up 15%. But your cap is 8%. You only get 8%. A participation rate means if the market goes up 10% and your rate is 70%, you get a 7% return. The superpower. Let's say the market crashes 20% this year. Your account drops by exactly 0%. You lose nothing except the chance to grow that year. When the market recovers, your past gains are permanently locked in, and you start growing from that new protected high point. Okay, how to turn it into a paycheck. Now let's talk about the scariest rumor out there. If I buy an annuity and get hit by a bus tomorrow, the insurance company keeps all my money. That rumor comes from a specific payout option called single life only. But the second you pass away, the contract is over. If you take one $1,000 check and die, the company keep your remaining $99,000 to fund the paychecks of folks who live to be 105. But here's the reality. You almost never have to choose single life only option. You can choose safer routes like a cash refund, guarantees they will never pay out less than you put in. Installment refund. Instead of a lump sum, they just keep sending your usual monthly check to your family until that remaining balance is fully paid out. A joint payout. The checks keep coming for as long as either you or your spouse is alive. Shielding the paycheck. Riders. You can buy optional upgrades for your contract, called riders. 1. Lifetime income riders. If you buy this, the insurance company basically keeps 2 sets of books. Book 1. This is your actual cash value. Book 2. This is your phantom money, a fabricated ledger used only to calculate your future paycheck. Before you retire, they guarantee your phantom money will grow by a set amount, say 6% a year. When you retire, they base your lifelong paycheck on that phantom number. The crazy part? Even if your real cash value drains down to absolute zero from your withdrawals or market crashes, they still have to pay you that exact same check every year until the day you die. The trade-off is an extra annual fee, usually 1% to 1.5%, deducted from your real cash. 2. Enhanced death benefits, the high water mark. If the market crashes the week before you pass away, you don't want your family inheriting a destroyed portfolio. You can buy a stepped-up rider to fix this. Here's how the math works. You invest $200,000. The market goes on a massive run, and your account hits $280,000. The insurance company takes a snapshot and permanently locks in $280,000 as your minimum death benefit. The next year, the market crashes, dragging your actual account value down to $190,000. If you pass away, your heirs don't get the crashed $190,000 value, and they don't just get your original $200,000 back. They get the locked-in high water mark of $280,000. The trap: surrender charges and IRS penalties. Before signing annuity contracts, you need to understand the lock on the vault door. Annuities are meant to be long-term. If you try to pull all your money out in the first few years, the insurance company will hit you with a surrender charge. It's a declining penalty. They might charge you a 7% penalty if you leave in year 1, 6% in year 2, steadily dropping until your money is fully liquid, usually around year 5 or 10. Even worse is the IRS trap. The IRS forces you to pull out your taxable gains first, before you can touch your untaxed principal. And if you pull money out before you turn 59 and a half, the IRS hits you with an extra 10% early withdrawal penalty on those gains. Do not lock your money up here if you think you will need it for an emergency next year. So, who is this actually for? Annuities are a highly polarizing financial tool. Skip an annuity if you don't have a robust emergency fund and liquid savings. If your goal is to beat inflation by a wide margin with aggressive stock market growth, the annuity is not for you. Your Social Security and existing nest egg comfortably cover your lifestyle already. You do not need the annuity. Look into an annuity if you are worried of running out of money and want a paycheck you cannot outlive. You don't have a pension and want to build a do-it-yourself one. Annuity is for you. You are a conservative retiree who wants a safe harbor from stock market volatility. Annuity is for you. The ultimate strategy. How do you actually use this? The most efficient way is the income floor strategy. Add up your essential survival bills. Let's say it's $5,000 a month. Subtract your guaranteed income, like Social Security or pension. If Social Security or pension pays you $3,000, you have a $2,000 gap. You use a piece of your savings to buy an annuity that pays exactly $2,000 a month. This guarantees your survival expenses are paid for life. Now you can leave the rest of your portfolio completely free and liquid to grow aggressively in the stock market without losing sleep. If you want aggressive growth and total control, skip annuities. But if you want a paycheck you can't outlive and sleep insurance during a market crash, they are absolutely worth a look. Annuities are not good. Annuities are not bad. They are tools. And tools only work when you understand how to use them properly. If this video brought you clarity, please hit the like button so more people can see clear financial education instead of misinformation. Please share this video with someone who's approaching retirement and feels confused about income planning. Please drop a comment below and tell me what part surprised you the most, the fees, the riders, or the payout options. And if you want more step-by-step breakdowns like this, not hype, not scare tactics, just real financial strategy, make sure you subscribe. Thanks for watching, and I'll see you in the next video.